Welcome to the deep dive. We cut through the clutter, pull out the key info from our sources, and help you see complex topics more clearly. Today, we're doing a deep dive into the world of ETFs. Our goal, to really understand what they are, focusing specifically on S&P 500 and gold ETFs, and importantly, how you can actually use them for smarter investing based on the material we've looked at. Think of this as your shortcut to getting properly informed on these tools. So for many people already investing, ETFs are probably familiar. But for those maybe wanting to go deeper or just starting out, how should we define an ETF? What makes it unique?
Okay, yeah. So ETF stands for Exchange Traded Fund. Think of it like a hybrid. It's an investment fund, sort of like a mutual fund you might know, but, and this is a keep it trades on stock exchanges. Just like, buying or selling shares in Apple or something. You can do it anytime the market's open at the current price. So very flexible.
Right, so it's got that fund aspect, but trades like a stock.
Exactly. And that's what's really powerful about them. They kind of combine the best bits of both. You get the diversification you'd expect from a fund, spreading your money across lots of different assets.
Yeah.
But you also get the real-time trading, the liquidity that you get with a single stock. It moves getting broad market exposure much, much simpler.
That diversification point is interesting. You mentioned a basket of assets. Just how wide can that basket be? What kind of things can ETFs actually track?
Well, it's incredibly broad now, really vast. You've got ETFs tracking domestic stocks, international stocks, different kinds of bonds, commodities like gold, which we'll get to, or oil. Even things like virtual assets are starting to see ETFs built around them. Pretty much anything you can think of an index for.
Wow, okay.
And that's why there's such a big deal for building a portfolio. It means investors, even regular folks, can easily access all these different markets and asset types. It makes smart asset allocation, which used to be quite complex, much more achievable.
Okay, so let's narrow down. If someone's thinking, I want an easy way to invest in the whole U.S. market, where do S&P 500 ETFs come in?
Right. An S&P 500 ETF is specifically designed to track the performance of the S&P 500 index. And that index, it's basically the top 500 largest companies listed in the U.S., judged by their market capitalization.
Right.
So it's a huge chunk of the U.S. economy.
The big players.
Exactly. You're talking about giants like Apple, Microsoft, Amazon, Tesla's in there, but also major banks, healthcare companies, industrial firms. It's broad.
And are there specific ones people might recognize?
Yeah, absolutely. Some of the really well-known ones are SPY. That's probably the oldest and biggest, VOO and IVV. They're super popular, especially for long-term investing. Why? Well, mainly because their operating fees are really low.
The cost factor.
Yes, and they're very liquid, easy to buy and sell lots of shares quickly. But it's worth remembering, because they track the broad market, they are sensitive to the big economic picture. Things like inflation scares or interest rate hikes definitely affect them.
You said it's the top 500 companies. Just how much of the U.S. stock market does that actually represent? It sounds like a lot.
It really is. The S&P 500 index covers roughly 80% of the total value of the U.S. stock market.
80%, wow.
Yeah, it's massive. But what's also interesting and important for investors to grasp is how concentrated it can be at the very top. While it's 500 companies, the performance is often heavily influenced by the biggest ones.
Like the Apples and Microsofts you mentioned.
Precisely. If you look at the weightings, Apple might be around 7%, Microsoft over 6%, Amazon near 4%, the two Google classes together over 5%. You quickly find that the top, say, 10 or 20 companies make up a really significant chunk of the index's total value and drive a lot of its movement.
So while it's diversified across 500 names, it's not equally weighted.
Not at all. Understanding that tech giants and other mega caps have such a big influence is pretty crucial.
Okay, this brings us to a really practical point for, our listener thinking about this. What are the clear advantages and maybe the disadvantages, the pros and cons?
Sure. On the plus side, S&P 500 ETFs are just a very straightforward way to get exposure to the wider U.S. economy. You're betting on America Inc., essentially. They're cost efficient. As we said, those low fees really add up over time. Historically, they've offered pretty solid long-term returns, though past performance is no guarantee, of course. And the high liquidity is a big plus. Easy in, easy out.
Okay, sounds pretty good. What's the catch? What are the things to watch out for?
Well, catch might be strong, but there are definitely things to consider. They track the market, so they go down with the market too. You will experience short-term volatility. Don't expect a smooth ride every day. Also, because it's diversified, you're unlikely to get that, 10x return you might get from picking one lucky individual stock. It's steadier, generally less explosive growth.
More moderate growth potential.
Exactly. And then there's exchange rate risk if you're not investing in US dollars. The value of the dollar itself can impact your returns. Oh, and sometimes the dividend yield might be a bit lower than you could get from specific high dividend stocks.
Right. Okay, that makes sense. So we've talked growth with the S&P 500. Let's pivot a bit. What about safety or hedging? Let's talk gold ETFs. Gold has that classic safe haven reputation.
It certainly does. And a gold ETF is basically a financial product designed to mirror the price movements of physical gold. So when the price of gold goes up or down, the ETF price should follow suit pretty closely. It lets you invest in gold without actually, buying bars or coins.
How do they do that? Do they actually hold gold?
Good question. There are generally two ways. Some of the big ones, like GLD or IAU, which are very popular, they actually do hold physical gold bars in secure vaults, backing the shares they issue. Others might use financial derivatives, like futures contracts, to track the gold price. But the goal is the same, give investors exposure to gold's price changes.
Why do people turn to gold? What's its traditional role?
Traditionally, yeah, it's seen as a defensive asset, a hedge against inflation, because its value isn't tied directly to a specific currency's printing press. And it often performs well during times of economic uncertainty or market stress. When stock markets are tumbling or there's geopolitical tension, you often see investors flock to gold, pushing its price up.
So it can act as a sort of portfolio insurance sometimes.
That's a good way to put it, yeah. It can help balance out the risks from other assets, like stocks.
So for the average person listening, what makes a gold ETF more practical than, say, actually buying some gold coins and sticking them in a safe?
The practicalities are huge. With a gold ETF, you completely avoid the headaches of physical ownership. No storage costs, no need for special insurance, no worries about security or authenticity.
Right, I can see that.
Plus, they are highly liquid. You can buy or sell shares instantly through your brokerage account, just like a stock. Trying to sell physical gold quickly and at a fair price can be much more challenging. So, ETFs make gold accessible and convenient for almost anyone.
Okay, so we've got a handle on what ETFs are, looked at S&P 500 for growth, gold for maybe some safety. Now, the really key part for listeners, how do you actually choose? If you decide an S&P 500 ETF is right for you, there isn't just one, right? You mentioned SPY, VOO, IVV.
Exactly. And this is where you need to do a little homework because they aren't all identical, even if they track the same index.
That's okay.
You need to compare them. Key differences pop up in things like tracking error. How accurately does the ETF actually follow the index? Sometimes there are small deviations, the operating fees, which we touched on, and also trading volume or liquidity.
So what are the key boxes to tick when comparing? What should someone look for?
Okay, several things. First, look at the underlying index itself. Is it reliable? What's actually in it? Makes sense for S&P 500, but maybe less clear for more niche ETFs. Second, consider the fund manager. Is it a large, reputable company? What's their track record? Third, and this is a big one, for long-term cost to total expense ratio, or TER.
TR. Right, you mentioned numbers like 0.03%.
Yeah, for VO on IVV, it's incredibly low, like 0.03%. SPY slightly higher, around 0.09%. These might seem tiny, but over 20 or 30 years, even small fee differences compound significantly.
Definitely worth checking. What else?
Fourth, look at trading volume and liquidity. Higher volume generally means tighter spreads the difference between buying and selling prices, which saves you money on trades. SPY has massive volume, it's great for active traders, but VOO and IVV are plenty liquid for most long-term investors too. And finally, maybe look at the ETF's past returns and its risk profile. Again, past performance isn't predictive, but it gives you some context.
Got it. Index, manager, fees, TER, volume, and history.
Exactly. And understanding these helps you manage risk, because it's important to remember even though ETFs are diversified, they can still lose significant value if the whole market tanks or if the sector they track gets hit hard.
Still exposed to market risk.
Absolutely. You still need to understand the economic environment and the specifics of whatever asset class the ETF holds before you jump in.
That actually brings up another risk factor we touched on, currency. For someone outside the U.S. buying, say, VOO, which is in dollars, how big a deal is that exchange rate risk?
It's definitely something to be aware of. If the U.S. dollar weakens against your home currency, it can eat into your returns even if the S&P 500 itself goes up, and vice versa.
Then what can you do about it?
Well, sometimes you can find currency-hedged versions of ETFs. These use financial tools to try and neutralize the impact of currency swings. They can reduce